In this article, I'm going to show you how a complete beginner can start making money by learning the basics of trading options. Hey, this is your Minister of Capitalism, Brett Davison. And first, let me say that it's possible to make $1 million trading options. Now, don't get too excited because most people lose money when they trade options. What if there was an easy way for beginners to start making money? Well, today I'm going to share with you the secret and some simple tricks so that you can start making money without risking much at all. So to answer the question, do people make millions of dollars trading options? The short answer is yes. Most traders will lose money though, and I will explain why in this article. Many people see options trading as a form of gambling. But it's just not the case. Options traders should be disciplined with their trades to increase their chances for success and larger profits. Anyone can trade options. It doesn't matter if they've never traded before. The only requirement is that the option trader needs to have a brokerage account, which most do. Is it really possible to make $1 million trading options? Yes. The most important thing to know is that any form of options trading can be risky, so it's best if you have money set aside for your trades. To give an example of the riskiness factor, a $30 stock option contract could cost as little as 50 cents or only around 20% of what stocks would. In order to make the same amount on a trade in stocks, one needs at least double their investment, which is also assuming they are right about whether or not the price will go up or down respectively. This means there are more potential success stories than failures when it comes to options trading. When you use simple options trading strategies and follow sound investment advice, like if you were to follow along the trade recommendations inside the Empirical Collective, you're likely to make money. What does it take to become a successful trader? A big part of a successful trader lies in trade management, where traders need to be able to manage their risk when it comes to trading. That's one nice thing about trading options and buying calls and puts. You know exactly how much your maximum downside risk is, because you can never lose more than you initially pay when you buy calls or puts. This is a perfect way of managing trade risk because you know exactly how much money you could lose in each and every trade. And understanding a trade's downside risk is an important part of becoming an options trader. Options trading involves buying or selling an option on a stock. Here are the basic steps to becoming rich trading options. At the core of this type of trading are calls and puts. A call is a contract that gives the owner of it, the call holder, the option to buy shares from or sell them to someone who owns an equivalent contract. A put is a contract that gives its owner, put holder, the right to sell stock at a designated price. The most basic options trading strategy is to simply buy a call or put on a stock. This is called the long position. If a trader buys a call, they are essentially saying that the stock will go up. If a trader buys a put, they are saying that the stock will go down. In order to make money in buying a call or a put, a trader needs to choose the correct strike price. The strike price is the stock price at which the buyer of a call option thinks the stock will increase beyond or stay above, whereas when someone buys a put, they would want the price of the stock to be below the strike price. A trader who has a long position buys on an option is betting that either their call or put will be in the money at the time of expiration, meaning they have more than what they are owed from the other party and can make money off it. That's the basic idea when it comes to basic option strategies and trading in the stock market. You can also sell calls or puts. If you sell an option, this is called writing options. If you were to sell a call, you make money when the stock price is below the strike. If you were to sell a put, you make money when the stock price is above the strike. If you sell an option, you immediately receive a credit balance in your account. A trader who has a short position sells on an option is betting that either their call or put will not be in the money at the time of expiration, meaning they owe more than what they are owed from the other party and can lose money off it. In this case, their goal is to have an option expire with no value, i.e., worthless. In this way, they are putting the power of time decay to work for them. So you can both buy and sell options. A more complex strategy on your way to making $1 million trading options. There are different strategies that you can use in combination to make up more complex option trading strategies, like an iron condor, for example. An iron condor is an option trade that is two positions, one short and one long. The strike prices for the two legs are typically set to be equidistant from each other with a vertical spread of, say, about 15%. The trader who sells this position is going to have a limited risk but limited profit. They will owe more than what they are owed when it's time to close out their trade. But by having two separate legs open in the trade, they can make money if the stock goes up, down, or stays the same in value, so long as it remains within the range made by both positions. For the vast majority of traders, it's best for them to start out with simple directional options trades by buying calls or puts. This can be accomplished with a single trade and is much less risky than an iron condor or other multi-leg options trades. Iron condors are more difficult to manage because of the increased risk. They're usually used by traders who have previous experience in trading options or those investors that can afford to take on higher risk for larger gains. Covered call is another classic option strategy. A covered call is a type of option strategy in which an investor or trader owns shares on the underlying stock and writes call options against those same shares. Covered calls are usually used to generate additional income from stocks that someone already owns. But there's also a long-term play with this strategy where a trader can sell covered calls on stocks that we don't own any funds in. For example, if one has $30 worth of cash available and they buy 100 shares at $25 per share, then they can write 15 synthetic contracts or 20 total because each contract is based on 100 shares. In order to take advantage of the potential profits without risking their entire investment, traders will use low strike prices so as not to have too much money tied up in case a trade goes against them. One big downside to this trade is that it requires a lot of capital, so it's not an easy strategy for beginners or someone starting out who might have a small trading account. The basics of a bear put spread. Another simple options trading strategy is what is called a bear put spread. To set up a bear put spread, you would buy a put option at one strike price and sell two puts with the same expiration date but different strike prices. Basics of a bull call spread. Similar to the bear put spread, a bull call spread is an options trading strategy where you would buy one call option while selling two calls with the same expiration date but different strike prices. This trade has lower risk than buying 100 shares because it requires less capital. Always remember that if you are going to be trading in high-risk investments like stocks or commodities, then you should have some basic education on how they work before putting any money down. A merit put spread. Another relatively simple options trading strategy is what is called a merit put spread. A merit put spread can be set up in many different ways, depending on which strike price of puts and stocks are chosen. For example, if a trader chooses to buy one of the money call option for 100 shares with a 30 expiration date and also buys an out of the money call option, meaning it has more time with 50 shares, they would then sell under the money put option for 100 shares with a 40 expiration date. This strategy is known as a merit put spread because both options share two things in common. They are both long positions on stock and short positions on puts. The investor receives their purchase cost back from the sale of the put that they placed. The merit put spread is a bullish strategy that has limited risk and unlimited reward potential. The investor only loses the initial investment, but can potentially make more if the price of the stock increases in value. They don't have to worry about how high or low it will go because they are at no risk for losses greater than their cost of purchase since they've already sold one option contract in order to hedge themselves against downside moves. If traders hold this position until expiration on both options, meaning 30 days, then there's a chance that prices could continue trading higher before entering into an annual cycle where shares typically decline again due to a demanding tax season. Long straddle. A long straddle is a strategy where a trader buys a call and put option at the same strike price with the same expiration date. A long straddle strategy is often used by traders who think that an asset's price will change significantly, but they don't know in which direction it will go. Since both options are purchased, there is no limit to how much money can be made on this trade, although if one of these positions were sold, then losses would eventually get capped. On the other hand, there isn't any protection against losses because when you sell an option contract to create hedging for yourself, you're already giving up some downside protection, so every day until expiration counts as potential loss. The best way to go for new traders. Inside the empirical collective, we've found that it's best for people to only buy options because they are cheaper than selling them and there aren't as many account restrictions or requirements for people to be able to trade them. So this means that even if people have very little experience trading options or have a small trading account size, they are still able to start trading with us. It's worth noting that it is possible for people to buy options without actually owning the underlying asset, which means they also don't have any risk if the trade goes against them and only stand to lose their initial investment in buying the option. This makes this type of investing a much more efficient way to get started with stocks as opposed to other investments because there isn't as much at stake. The majority of investors will find themselves on the winning side of trades when they are disciplined enough not to use leverage, which magnifies returns but increases losses, or over-leverage themselves by taking too many risks, like gambling. When it comes to trading options, we highly recommend that people never day trade. This is because day trading is not only one of the most risky investments, but it also requires a very high level of risk tolerance, discipline, and you are required to have a minimum $25,000 in a trading account in order to qualify to be able to day trade. But we feel that the advantages of trading options far outweigh some of the disadvantages. The advantages of buying options for the new options trader. Anyone can trade options with a small initial investment of $500 or less. The leverage is much lower than on stocks, which means that the losses are also substantially reduced. This makes it easier to get back into the market when you have a trade go against you. You can invest a much smaller amount than compared to buying stock or shorting it, as each option contract typically controls 100 shares and costs a fraction of the share price. So you can experience all of the positive benefits of the stock's movements while investing a tiny fraction of what it would have cost you. What are the disadvantages of trading options? There are some people who do not like that they require more knowledge to trade than stocks. Of course, if you sign up for membership inside the Empirical Collective, you will be able to leverage our experience and wisdom to help you get started trading options and gain the knowledge necessary for success. This is what we do, so why not learn as you follow our trade alerts? By doing this, you will be able to start with a winning team, as our trade success rate averages 94% and our return per trade is often above 24%. In signing up, it gives you an opportunity that would otherwise be unattainable without lots of money or time, which most people don't have these days. We believe that the key ingredient in being a millionaire is intelligence or hard work. It's self-discipline. It's just like working out with weights every day until your muscles start bulging through. It's the same with your finances. If you do the right thing over and over, you will begin to see incredible gains. But you've got to start the right way. Just like if you lift weights with bad form when you start, you're only going to get hurt. And the same way, if you use the wrong strategies when starting out, you're going to get hurt too. Which is why it's so important to follow along the trades of someone who's actually had success in the market, so you can get a feel for how it all works. In this video, I showed you how a complete beginner can get started trading options. Hopefully these tricks will inspire you to get your feet wet as well. Remember that starting out small is important because of all the risks involved when trading options. In closing, this is your Minister of Capitalism, Brett Davison. If you would like your bank account's morale to improve without having to beat it into compliance, join us on the inside at theempiricalcollective.com.